Hey guys, before we get into today's episode, I just want to remind you that we are going to be doing a breakout session for BDOs at the Mid Americas Lenders Conference in Houston, Texas on April 15th, my son's birthday. If you want to level up your game in 2025, come see us live in person at MALC. The link to register is in the show notes, and we will see you there.
Warning. The views and opinions expressed in this program are our own and/or those of our guests. They do not necessarily reflect the views or positions of our employers. Viewers' discretion is advised.
If you're a lender, a search funder deal can honestly be one of your easier loans to get done.
And that's what really makes a really sweet and good search funder deal, in my opinion. Ones that I want to take a look at.
My issues that I have with search funder deals, or some of them, is
We are so back. I feel I'm on top of the world. I'd like to open up honestly. Shout outs and congratulations to America's sweetheart for welcoming his third child, his second daughter. Congratulations, Ryan Collins, to you, your whole family. Congratulations. And more importantly, I know that your daughter came 2 days ago. I also know we talked about a deal together yesterday. So it's good to know that you're still grinding. I like that energy.
He closed a deal like yesterday or today. He's got like kid out, deals out, boom.
And you know what? Because he just had a daughter, I didn't steal a deal from him. I sent it to I was showing to Alan and Sterling, like, oh, this is Ryan Collins' term sheet of shopping. I was like, guy just had a baby. Jesus Christ. Like, give him a break. I'm not touching this.
Yeah. Well, then Mary was literally like funding a deal as she was having a baby. So then naturally Ryan needed to just one up her for some odd reason.
So I'm here at this conference with the Midwest Business Broker Intermediaries.
MBBI.
Yeah, and they have this screen that shows all the collaborations between members and everything. And I swear, if Ryan Collins' name wasn't on every single collaboration, just Ryan Collins.
I did that.
Mr. Midwest.
You made a big mistake, though, Hackney. You should have stole that deal from him because, honestly, public school builds character, and
I did say that. I was like, should I take this from Ryan and make his daughter go to public school for 1 year? Just 1 year only. She has to get it out the mud.
Hey everyone, welcome back to the BDO Show, a podcast for passionate BDOs wanting to level up their game with advice and stories from battle-tested BDOs. I'm your co-host, Emily, and I'm here with my fellow co-hosts, Alan Peterson, Chris Hackney, Sterling Birdsong, and Ryan Kroge. At the beginning of each episode, we're always going to remind you to subscribe and smash that like button and send your topics and suggestions over to the BDO Show at artofsba.com. And do not forget to check out our whole family of shows, including SBA Today, which airs live every week on LinkedIn, as well as our flagship program, the Art of SBA Lending Podcast. Okay, BDOs, it's story time. And no, I am not talking about the time Sterling tried to finance a zoo. You'll have to go back to episode 3 for that. I'm talking about the story that your borrower has in their head, and they may need that extra boost to finally get it onto paper. Rapid Business Plans is a known and trusted partner that can help them do just that. Whether your borrowers are working towards acquiring a business, starting one up, or expanding and making moves, within just a few short days, Rapid Business Plans will deliver powerful, fast SBA and USDA-ready business plans with projections and assumptions. If they need an export business plan for an ITL loan or a feasibility study, they have you covered there too. We know this process is not a walk in the park, or should I say zoo. Let the Rapid Business Plans team take some of the wild out of the process so that your borrower's vision and passions can come to life. For more information or to get acquainted, email Bethany McClellan at bethany@rapidbusinessplans.com or click the link in the show notes.
Guys, how good was the BDO retreat? Honestly, not even a plug.
Oh, that was great.
Yeah.
Shout outs to everybody that came, man.
Phenomenal.
Only thing better would be an SBA Today episode.
The number one podcast.
Number one podcast in SBA.
Coleman
SBA
rated.
Today.
Number one
Coleman
podcast.
rated. And you know those guys at Coleman. They're strict.
But seriously, I do like SBA Today. It's short form content, I guess. I get all the news that I need in SBA SOP updates and changes to the program. And Nagel is just dry in those emails sometimes. So Tanya and Paul, keep up the great work. Congrats on
congrats
winning
Tanya
your
and Paul. We
award.
love you
Congrats,
guys.
Tanya and Paul. It's like the Spark Notes, but I call it the Tanya and Paul Notes. You know what I mean? It's just, it's like Reader's Digest. It's all killer, no filler. Get your news every Tuesday at 2 p.m. And don't forget to support
SBA
our flagship publication, Art of SBA, which I can't believe it. I was invited back on there. That episode's dropping soon. You know, I was with another Coleman Award winner on that bad boy. So shout outs to them.
And don't forget, we have another live performance coming up at MALC. And actually, you know what? It's April 15th, which is my son's birthday. So I will not forget that date.
All right, guys. So why don't we go ahead and get into the episode? Today, we are going to be talking about search funders, the good, the bad, and the opportunistic. Now, for everybody who's new here or does not know, Ryan, why don't you go ahead from that bar stool and tell us what search funders are?
So search funders can be an individual or a group of individuals that are getting together to pool their resources, their talents, their resources, whether it's monetarily or just intellectually, to be able to acquire businesses. And it's taking on quite an impressive life because they're utilizing social media, they're utilizing technology to find each other all across the country to be able to come together and acquire businesses. And it's really cool. It's created a community of like-minded individuals who, one way or another, are using their transferable experience to acquire businesses, grow businesses, and is sometimes acquiring several to be able to grow them. It's just become a great way to be able to multiply your ability to buy or acquire larger businesses with a little amount of money.
Sterling or Chris, have you guys ever dealt with like search funders before?
Yeah, I mean, I've looked at a couple of search funder deals. To be honest, it really hasn't been a huge fit for our credit risk appetite at Bay First. I think that a lot of times what you see with the search funders, and you know, the reason that sometimes they get a little bit of a bad knock at some banks is because a lot of times it's a super young individual. They don't have a lot of life experience. They don't have a super deep balance sheet. They're probably light in liquidity. They're light in assets. They're light in experience in the industry that they want to acquire the business in. Usually what they're bringing to the team is, you know, their knowledge, right? They're usually well-educated people. They understand how to structure a deal. And oftentimes they may have an MBA behind them. So they're usually well-educated people, but, you know, they may be 25 years old. They may be 28 years old. They haven't had a ton of time to actually build something for themselves yet in terms of, you know, some type of a net worth. So that's the issue that a lot of banks have with it, is that, you know, you have these young guys who are being propped up sometimes by some investor cash, but they're the only ones who are actually signing the personal guarantee. And so if that business doesn't work out, what are you realistically going to get from a guy who's 25 years old who just has a Wharton MBA behind him and nothing else? You're not going to be able to get too much, right? And on top of that, if you also have somebody who doesn't have direct industry experience, the chances of the deal potentially going south also are increased as well. So that's why a lot of banks are hesitant to kind of jump into the search funder deals. And listen, this is not every search funder deal. There are some fantastic search funders out there, and not every search funder is a young person either. A lot of times they can also be older, and they can be potentially looking at a second career for themselves as well. But the ones that banks are most hesitant to take a flyer on are just like the ones that I described.
Kind of piggybacking on what you said, Sterling, I think the ones that are actually becoming successful, the ones that I am trying to search out myself, are the young kids that, I don't say kids, it's because I'm old, right? Anybody under 35 is a kid to me, okay? So the younger individuals who want to go out there and get that C-level suite position, who are able to utilize technology, utilize resources, and generate funds for a down payment. But the smart ones are also finding experience. They're finding individuals within that industry who also have a like mind, that want to acquire a business, that want to own a business, but they don't have the resources for a down payment, or they don't have the resources for the collaboration to be able to make that acquisition. I think those are the really successful search funders. They're the ones that I want to do business with, because you've got two different points coming together. You got the young that are able to be inventive, that are able to use technology, that are able to pool funds to be able to put it out in down payment. And then you got the experience, the seasoned individuals coming along who have that transferable experience, who have the knowledge to be able to run the business. And that's what really makes a really sweet and good search funder deal, in my opinion, ones that I want to take a look at.
So we kind of just explained, search funders. And now, Chris, from your experience, what do you think makes search funders appealing to both lenders and borrowers?
I mean, if we're talking to banks, it's simply because of the loan size, if we're being honest. If search funders were only looking at deals that were $500,000 to $1 million, it wouldn't be of interest to banks. Typically, search funders are looking for the largest acquisition they can afford. You're talking $3, $4, $5 million, punching usually above their weight, based on their personal financial statement, not maybe their investors' personal financial statement. So I think the interest and the appeal for banks and borrowers is you can do larger loans, and a lot of them, and there's a lot of this activity out there. I'd be interested to see if search funders just all switch to, hey, we only want to buy small, businesses under $1 million and focus on, small Main Street landscaping companies under $500,000. I don't think there's any interest in it at that point. The appeal to borrowers with search funders, I mean, if I'm a search funder, I'm not. There's no risk for me. If I'm a, young, I'll say less seasoned person, I don't have experience, I don't have capital. All I have to do is structure the deal, find a bank, find some investors, which there is work that's involved in doing that. But if the loan goes south, I'm not losing anything. I'm just starting out earlier in life. I'm not putting up any capital. I don't have anything to really take if the loan goes bad. So that's the appeal to a borrower if you're in a search funder transaction.
But I do think that overall, I feel like there is a need for them because when you think about the silver tsunami, right? We all hear about it. All these baby boomers are getting older. All these businesses are going to need to transition. Some of them are going to transition. Some of them are not going to transition. But either way, there's going to be market share that's available. And a lot of these people do not actually want to sell to their kids, or their kids don't want to buy from them. And so you need somebody who's a third party to essentially come in and buy these businesses. And at least I feel like search funders are trying to fill that need. They see the availability in the market, and they know that these businesses have to go to someone, and why not let that somebody be me? And they do understand, at least on a high level, what a bank is looking for in terms of just getting through the loan process, the financials that it takes. I mean, if you're a lender, a search funder deal can honestly be one of your easier loans to get done, just because they are very sophisticated borrowers. They actually know exactly what it is you're asking and why you're asking for it. And they're going to get it to you with a very minimal fuss because they just get it. And so that's another reason why it's attractive to the bank, because, you do a $5 million search funder deal and you probably put in less work than a $500,000 startup franchise deal for someone who's never owned a business before. And they're asking you why I have to fill out a personal financial statement and how to fill out a personal financial statement. Those are the type of stuff, especially as you start to progress as a lender, you just don't want to deal with it. The juice is not worth the squeeze. And so, it is attractive to deal with some of these search funder guys, even if it is more of a risk. Ultimately, we all have goals that we're trying to hit. Our institutions have goals that they're trying to hit. And you can do a bunch of small loans, or you can do a few large loans, and sometimes it comes out in the wash. And so that's another reason why I do think that they're good in a way, and they're necessary in the space. And I certainly don't think that they're going to be going anywhere.
I do think they're necessary for the transition to silver tsunami. My issues that I have with search funder deals, or some of them, is the whole, going back to spirit of the program, which is the theme for this year, is to promote access to capital for people who typically would not. A typical search funder deal involves a money guy or gal who's a silent partner who's circumventing the guarantee. So that guarantor, who lacks experience and liquidity, they have access to capital, but that person just doesn't want to put their capital up, that minority partner. They want to leverage the government guaranteed program rather than putting up their own capital, which just shows they're just not interested, if the loan goes south, in helping out the bank in any form or fashion, because they're already starting out circumventing the guarantee. The program of SBA is designed to promote access to capital, and I just don't think a lot of the search funder deals that I see they don't align with the spirit of the program.
I think that we as SBA lenders sometimes forget how the conventional side of the bank works, especially on these larger C&I type of deals. It is not uncommon for there not to be a personal guarantee when it comes to bank lending, especially when you get into some of these larger businesses. I'm talking about, $100 million plus, true middle market type businesses. It's really not uncommon for a borrower to essentially search around and go to different banks until they don't have to sign a personal guarantee. And then they still want to get the loan done off of enterprise value, right? So these are the types of things that, we think about it in SBA. And we're like, oh, this person's trying to get cute and stuff. And, part of the double-edged sword of you dealing with more sophisticated customers and making the loan process easier for you is that they understand how banking works when they move up the ladder as well. And they kind of expect that same treatment. So it's kind of a double-edged sword in that aspect.
But when they're doing conventional financing is, the down payments are larger. The reason they're going SBA is because the terms are more favorable and
right.
they can leverage the program, right? So they can put 10% down.
If there's anything that I've learned over the last 25 years in SBA lending, or 26 now, is that the SBA is very knee-jerk reaction. They're very reactionary. They'll put out a lot of different rules, policies, procedures until somebody finds a loophole, until somebody finds a way to skirt the system to get out of the spirit of the program, as Chris said. And then they take a knee-jerk reaction and they really pull back on the entire program. They pull back way too hard, way too fast, and way too conservatively. And then we all have to suffer as a result. Main Street suffers, so on and so forth. Here's the danger that I see in search funding.
Hey guys, we have a special announcement for anybody involved in M&A transactions. Our partner, Peak Business Valuation, have put together a resource just for BDO Show listeners, and they're giving it away for free. It lists out the rule of thumb formulas, or as Kroge would like to say, the down and dirty, for some of the most common industries that SBA lenders finance. I promise you it's going to come in handy. Kroge's literally still using the one he got from Nagel in 2002. By the way, if you're not thinking about evaluation at the pre-screen phase, you are missing the boat. A lot of BDOs tend to focus on the debt service coverage and they're missing the valuation completely. That's a rookie move and it will become a problem. As a consultative BDO, you should have a sense of whether the business is going to value out. And Peak's handy dandy rule of thumb is here to help. Go to peakbizval.com/BDO show to get yours today.
So this can be into the future of the program as well, because it gives an opportunity for lower middle market people to come down and act like private equity firms. Okay. You can get a whole bunch of individuals, 10, 15 individuals, and utilizing the program's rules, they can acquire a $5 million business, put one person out of those 15 up as the guarantor, as the straw man, while they're using the program to keep the owner on as the actual operator. And then they can wash, rinse, repeat to every single customer until they've got a portfolio. And now they're looking like a PE firm, right? Now they've got 15 different companies. And heck, even utilizing the NAICS codes, they can even go bigger than that and guarantee multiple
the game changer
loans.
Right there. Right?
Yeah.
That's what really changed it.
I can see that if this is allowed to go unchecked, it promotes the program. It gets money out there. Lenders are going to be really happy because they get solid loans, big loans in their portfolio that are performing and that they're getting paid on, right? The downside of this is, how is this really helping Main Street? How is this really helping the small business owner that wants to acquire the same business, be there every single day, run it every single day, and leave a legacy for their family or somebody else, when you have these individuals acting like private equity firms from a lower middle market perspective, just pulling them up, utilizing their pool resources.
Yeah, exactly. That's all they want to say is the roll up and the hold co and all this type of stuff. And
this is where I think it can get dangerous. Now, I love talking about the spirit of the program. I spoke earlier on where I think is the perfect strike zone for the type of searcher that I want to do business with. But this is the danger. This is where I can see in the future the SBA catching wind, figuring this out and saying, oh, now we got to stop. Now we can't do any 100% financing. No more staying on board for the seller. So a lot of those rules came in after 2008 because lenders were abusing the system.
Now, to be fair though, and play devil's advocate, are a lot of PE firms failing? Have you heard of a lot of PE firms that are failing? I don't know. It's a genuine question.
But that's what I said. That's what I said. They're still performing. There's still good loans. I didn't say anything about failing. I'm just saying that it's getting out of the spirit of the program, because instead of Main Street individuals, Main Street operators who want to buy these businesses, get into these businesses, run them and leave a legacy, we've got these PE firms, these mini PE firms from searchers and individuals coming from middle market to lower middle market and rolling them all up. Again, to me, that goes out of the spirit of the program. Yeah, they're going to pay. I think they're going to be great.
But the PE firms, like, eventually it will. And so what's happened in the veterinary industry, I used to lend a lot in there. The multiples, you just can't keep up. The multiples get higher, then they roll that up to the next person. Eventually, I can't pay. I had some clients in the veterinary space that sold their business for like 10, 12 times multiple, right? Eventually, the person at the top can't afford to pay 20 times multiple on that business. So they're like, no, you stay down there, and it all gets squeezed. Right.
Right.
Then the industry goes to crap. Now that takes a longer time than like one individual SBA loan, and you're looking at a search funder deal. But the PE model, it just goes from industry to industry, right? So that's why you see the veterinary space is dried up, right? People aren't really doing that. Then they go to insurance. Then they go to now service-based businesses, and everybody wants to buy HVAC plumber and the fencing and all that stuff.
Well, and that's just it. That's the hotness right now, is anything with a license. Contractors, HVAC, electrical, plumbing. They're trying to get gobbled up out there in the market as much as possible by PE firms or some of these smaller searcher firms. And then so are CPA firms, dental practices, chiropractors. They're all getting gobbled up by these large conglomerates. And what they're offering in these real PE firms, not using SBA money, is they're keeping the owner on salary as a consultant, paying him a fee to keep these operations going, but then handing them out a check. Whereas in their industry, they might get into free market 5 times multiple. They're paying them 10 times multiple.
Yeah. Well, but also, just to be clear here, when we're talking about the spirit of the program, ultimately who dictates the spirit of the program is the SBA, right? The Small Business Administration, the government. From what I've seen this week, particularly from the OBM, it sounds like the new spirit of the program is remaining zero subsidy. And so that's what we need to be focused on ultimately. Right. And I think that, I'd be curious to see what search funder deals perform like over a long period of time, to see if they actually are riskier or if they're not as risky, because the proof is in the pudding, right? At the end of the day, either these are good deals on the whole for the most part, and they're actually paying back and they're actually a little bit safer, or maybe they're not. And at that point, they're definitely not in the spirit of the program, and they have to go.
If you do it up based upon cash flow, you should be fine, and hopefully you never get to that point where you're calling on the guarantors or, hoping that the minority partner non-guarantors would write a check. So I think, the deals themselves are okay performance-wise so far from what I've seen. I just take issue with leveraging a program when you already have access to capital and can do it by other means. I'm not saying that they're bad loans from performance standpoint, because we're not far enough along into this type of search funder structure. I think we're, let's say, what are we, maybe 4 years into it, maybe 2019-ish, 5 years or so, 6 years. I think you got to have a full 10 years to really understand, okay, this works.
You need a real cycle. You need to be able to see a full cycle. Okay. And I hate to play devil's advocate again here, but we're talking about access to capital. And we really need to define what that actually means, because a lot of these guys who are on the cap table of a search fund, they're guys who have like 500K, or maybe they have 7 figures in liquidity in a good situation. Does that mean that they actually have access to capital that's not an SBA loan to go and acquire a $4 million business? I'm not really sure that they do, because I don't really think that there's a product in the market for this size of business that you could acquire without using an SBA loan. So, do they actually have access to capital? I would argue that maybe they don't actually have access to capital without using the SBA. But I think what you're saying is that they also need to guarantee.
Yeah. And the key is, the reason they're able to buy a $4 million business is because the SBA is providing a 75% guarantee. Now, if you got $1 million, maybe you need to punch at a $1.5 million weight class or a $2 million acquisition. Again, this goes back to loan size. So the whole reason search funders like SBA and banks like SBA, because these deals are bigger. So if I'm a minority partner, I've got $1 million in cash, I could probably swing a $2 million deal and get a conventional loan for $1 million, or whatever that structure is. But if I want to get a $4 or $5 million deal, which I understand because the multiples are greater, more cash in my pocket, I'm going to leverage SBA.
The thing is, I don't think you actually can, though, Chris. I don't think you can get a $2 million deal if you have $1 million. I don't know of anyone who's really doing enterprise lending in the SBA size space. I don't think there's really a lender out there that's saying, hey, I would do a $3 million deal if you put up 1.5.
Yeah, I'm not talking about just straight debt. I'm talking like you could put together a capital stack from different partners, different sources of debt. I'm not saying like there's a bank that specializes in
I'm talking about
micro.
I got you.
Yeah, exactly. You could call Hyro up and say, hey, I need $500,000. You can go to your buddy and your friends and family, get another $500,000. You put up $500,000, and then it gets to the $2 million. So there's a way you can put together a capital stack, but yeah, again, I think performance-wise, search funder deals are fine.
And the searchers are doing that too, which I think is also a great part of how they've kind of come together with technology and their ability to acquire bigger deals with more money down.
All right, so we just covered a lot, and I love the information. I love the education. Let's talk to some of the BDOs and let's educate them in how to protect themselves and their clients when working with search funders. Ryan, what do you got to say about that?
So it all goes back to my early days in lending, where you have to know your customer, be a relationship banker. I've said this one time, I've said it a million times on this podcast. Know your customer and build relationships. The more you know about your customer, the less likely it is for you to get sucked into something that's going to cause fraud and is going to defraud your bank. All right. So when you have these searchers or anybody, any type of customer that's coming in and asking for an SBA loan for a business acquisition, know who they are, who the players are, who's involved. For crying out loud, read that purchase agreement. Read all of them. I can't tell you how many times I rolled out PE type acquisitions. Heck, I looked at a transaction where I had an LOI and then it had an exhibit attached to the LOI, but it wasn't attached to the one that I got. That there was a PE firm that negotiated a $2 million deal for a business acquisition, but the LOI I had was for 2.5. And so what they were doing is they were charging $500,000 to assign that LOI to other PE people that were acquiring it, putting $500,000 down, and they were recouping their down payment on every single transaction.
Cool.
That's not cool. That's not in the spirit of the program. It was kind of slick. It was pretty slick, to tell you the truth. And if they did it a different way and had side agreements, I would have never have known. But because I was able to, I read the LOI, I read through the agreements. I turned them away. I said, we can't do that. You guys are recouping. You're assigning a transaction, and you're assigning it for more than what the business owner is actually getting. That's not eligible. You can't do this type of stuff. And so they kept pushing the deal, and then they wrote a purchase agreement. And then I found out that there was another clause put in the back of the purchase agreement after, again, reading through it, that they were still hiding that $500,000 assigning fee to recoup their down payment. And so I just told them, look, guys, I can't do business with you anymore. No more loans, no more deals. Don't come to me. And then I sent a bulletin out to everybody within my bank that if they get something from these 4 individuals that run this firm, this is what they're doing, and that we shouldn't be doing business with them.
Protecting yourself as a BDO, protecting your client, protecting your bank, like protect your tribe, everybody, because it would trickle, and that would be awful.
Protect your neck, kid.
Yep. Sterling, what do you think about how would you say to a BDO to educate and protect themselves when they work with search funders?
Listen, I think it seems like I'm probably the more liberal of these two when it comes to dealing with the search funders. I think for the most part, a lot of these are really good people who mean well, and they see.
Hey, I like them too. I'm just pointing out the bad stuff. I like the search funders.
I love search funders, unlike Chris and Ryan. Chris and Ryan absolutely hate search funds.
I love search funders. Stop.
My Dwight Eisenhower poster over my bed.
I've got a poster
Dwight Eisenhower's turning over in his grave.
Yeah. Listen, don't forget who loves you. If you're a search funder out there, don't forget who had your back on this podcast.
Yeah, this will be on what is it? SMB Twitter.
Love search funders. Love you guys. Give me a call.
SMB this, SMB that.
Yeah.
SMB. ETA, baby. ETA.
SMB
Give me a call. Let's go. I'm in.
Shout out
you guys.
Shout out to the search funders, man. I'm down.
All the real search funders out there.
All right, we got Alan back. He was on a call. Why don't you jump in here and talk about search funders a little bit?
So the search fund model is part of the broader ETA movement, right? Entrepreneurship through acquisition. statistically buying an existing business that's already been operational, it has a foundation, it has systems in place, it has employees in place. Statistically, buying a well-established business is significantly less risky than starting a business up. Plenty of data that supports that. That's non-negotiable, regardless of personal opinions on the quality of credit or the use. I'm just giving you the facts, okay? So there's two ways to do it. There's the traditional search fund, which is where ultimately you get a lot of folks together that raise money and they look for businesses to buy, and they handle things with a group of investors that ultimately will be the board and they'll have equity positions. There's also the self-funded search model. The self-funded search model is when you have a sponsor who is going to utilize SBA loan very often to buy the business, right? So that's kind of what it is. But when it comes to like the risk on the deals, I think where people get caught up in it, and a lot of other BDOs listening have definitely seen or have heard that inbox, hey, I'm doing a home healthcare roll-up. I've got a board of advisors, but I don't have any experience. I don't have any money.
Shout out to Dan Pena.
But yeah, right. Then you get somebody that, you know, is sending you a PDF with a couple headshots of a retired hospital executive who's not putting money into the deal, is not going to be a minority owner of the deal, is not going to be actively managing the deal,
but not alive
for
any
some
longer.
reason.
Yeah.
Right. That PDF is supposed to give you the warm and fuzzies. Those aren't the deals that I'm doing, you know, that most folks I know are doing. We also have to be aware of the fact that now that double blocks are not penciling the way they used to, the mad dash on guru culture is buy a business with zero down. It's a more and more of a Main Street concept. And with that means we need to keep our guards up and remember that we need to protect our institution and protect ourselves, because our reputations are everything, and they follow us no matter what bank we're at, no matter what polo we're wearing, no matter what comp plan we're on, no matter how much we're paying. By the way, Sterling, I think you're back to 1 this quarter, but we'll see. Anyway,
hey,
I'm always
when I'm
I can press the button anytime, y'all. Relax.
Hey,
Don't do
we can
it.
take it
I
up
can
one
press
notch
Don't do
anytime we
So-
want.
so-
do
we
it,
can go
so
from 1 to 2.
You know I love
Don't
setting
hurt
you
him,
up for
Hammer.
those.
Don't
To
hurt
you
him.
guys.
So anyway, all of that is to say, I've worked some great deals for self-funded searchers who are people that in the past have managed budgets, people, or operations in a real capacity. These are people that have experience that is truly transferable and are putting their own equity injection into the deal. They might be using investor funds, but they certainly have skin in the game as well. Okay? We need to look out for the same guardrails that every deal needs it anyway. I just think there's a lot of noise like, oh, search fund, because it's like there's so much trash that's flying that flag. Listen, there's a couple Dave Matthews Band songs I like, but I would never admit it because I hate their fans so much. Okay, it's the same thing.
Hey, we love
Okay?
Dave.
Yeah.
Not everybody is created equal, right? You know, the same thing with like not every SBA lender is created equal. Not every search funder is created equal as well.
That's correct.
Right.
And when you get the folks, then they say, okay, well, how do you evaluate a self-funded search deal? Transferable experience,
Yep.
liquidity,
Right.
the performance of the target business. How does that borrower integrate with that? Right? What are they really on the hook for? We're evaluating it just like every loan.
Yeah.
Right. We're not going to
Sustainability of the business and propriety to pay.
That's it.
That's it.
You know, we're gonna avoid, you know, functional obsolescence any way we can,
My man.
and we're gonna try to do. Hey, we're back in season 2,
The
baby.
funniest thing
Shout
to me
out.
is like, hey,
Shout
I'm
out to
a
functional
self-funded
obsolescence.
searcher. I'm a self-funded searcher. It's like, so you're just a business buyer? I mean, what is the difference between a self-funded searcher versus someone who just wants to buy a business? Isn't it the same thing?
It's a way to differentiate from the original traditional search model. But at the end of the day, yeah, it's guys and gals, they're buying businesses. And, you know, I work with a lot of veterans in that space. I don't know if you guys know that, but I mean, that's a whole movement.
The modern way is to utilize that technology. Utilize that technology.
If you don't support the troops.
I love our troops.
We love the troops, first of all.
At the end of the day, all jokes aside, is you guys aren't wrong. And we've had these conversations before. We had them in person. when you're out there to your BDO and you want to start chasing biz acts, remember that you need to be focused on doing good business acquisitions, regardless of what you call them, regardless of what the model is, regardless of how it works. If you're given a Microsoft Word document with a headshot of a recently deceased hospital executive, and you've got a PFS with $4,000 on it, a FICO of 620, and a gift from grandma, who's coincidentally also deceased, pass on the paper. It's on the paper. It's not that complicated.
Pass on the paper,
baby. You just pass on the paper. Save it. Protect your time.
Yeah, we should wrap.
Protect your neck.
Okay. All right, everybody. Well, thanks for joining us. If you have any questions about search funders, these guys are always available. They're on LinkedIn. You can catch them wherever their emails.
Searchfunder.com. I'm very, very active on searchfunder.com. Check me out there.
So am I.
And
I'm active on searchfunder.com as well.
I'm on SMB Twitter and SMB .org.
No, you're not.
SMB.
No, you're not. And I'll tell you.
.SMB.
No, you're not.
It's like I'm not.
No, you're not.
He's not because I am there and I don't see him. So
I'm on the SMB Reddit, SMB Facebook.
I really am trying that Reddit, but my engagement's been terrible on that. By the way, last season I was, I'm creating a whole Reddit subculture. I'm going to be early to the party, and I'm going to.
Is people still on Reddit?
You got to. No, and and certainly not the people I want to talk to. You got to fish where the fish are. I got some guy in the DMs asking to look at bikini pics of my wife.
Oh my God, Alex, stop.
When all else is equal, get yourself some good brokers like my man Tom Flanagan over here. Say hi, Tom.
Flanagan.
Cheers.
Tom Flanagan.
Guys, let me end this.
The original Matt Breslow.
That's right. The original
Jake Stone. I'm in the Stone Zone.
Stone Zone.
Stone Zone with Jake Zone. We out here.
He's still snoozing, man. He's an old school guy.
All the way from Wisconsin. He's drinking Spotted Cow beer in the Midwest.
Hey,
he's driving a snowmobile over Frozen Lake drinking booze.
He's got a cheese cube in there.
He's got a cheese cube in his drink. Oh,
that's how they do in Wisconsin.
I love that.
And if you're in Wisconsin, never order an old fashioned. You're not going to get what you think you're going to get.
They muddle it too much, right? Don't they just? Yeah.
All it is just that sour stuff. It's horrible.
All right, guys, great episode. Yeah. If anybody has some lingering questions about search funders, you can reach these guys on multiple platforms, or you can send an email to the BDO Show at artofsba.com. And again, thank you for joining us. Don't forget to check out our other programs as well. We have SBA Today, airs live every week on LinkedIn, as well as our flagship program, the Art of SBA Lending podcast. And we will see you guys next time.